Hello, everyone. Welcome to our Understanding Lessors Risk webinar for today. My name is Anae Agostini. I'm CEO of CID Insurance Programs, and I want to introduce Michelle Belden, who's our commercial underwriter who specializes in Lessors Risk underwriting. And say hello, Michelle.
Good morning, everyone.
And then Jacob Cole is our marketing coordinator, and he works behind the scenes to make everything run smoothly. So say hi, Jacob.
Hello, everyone.
Okay, without further ado, let's talk about the logistics, which are super easy, because most of you have attended a webinar like this before. You will be on mute, but you'll of course be able to hear and see, but you won't be able to speak. But your questions are important to us, so please pose them in the chat room, and we'll answer them throughout the webinar as they come in. At the end, there'll be a short survey, and that will pop up. We'd really appreciate your feedback. That's important to us. Okay, let's get started with objectives, and then I'll turn it over to Michelle. So we're talking about Lessors Risk today, and it's going to be important. There's so many different types of commercial buildings, so understanding the different types of commercial buildings and how to insure them is going to be important. Also, underwriting guidelines that need to be considered is key. A lot of things are changing in the industry, so you know, she's also going to talk about those industry trends and changes that are happening. A lot of it, you know, the market is hardening due to the COVID situation, and that's having an impact in lots of classes of business, and Lessors Risk is potentially one of them. We also want to talk about the property components that you need to pay attention to when insuring a Lessors Risk, and that is and then how to insure them. And then Michelle's going to talk about how to get fast and quotable submissions, how to and get a quote from her quickly. And that's really the secret, is she's going to tell you about that. And then again, I mentioned that there's a lot of changes going on, and so she's going to talk about what to anticipate going forward. Without further ado, I'm going to turn it over to Michelle.
Thanks, Anae. Again, hi, everyone. So like Anae said, we're going to go over Lessors Risk today. So here is a basic definition of what is defined as a Lessors Risk. I'm not going to read this to you guys because I know you guys are capable of doing that. But, you know, the ultimate thing you want to get out of what the coverage is for the Lessors Risk is providing coverage for the landlord or the building owner, however you want to distinguish them. So it's determining, the most important factor is determining who is the building owner versus who is the tenant. Sometimes the building owner could also be the tenant, but they own the building, say, in their individual name or an LLC, and then their business is its own corporation or its own LLC. Even though they're owned by the same entity, there is a separation. One is still the building owner, and then one is still the tenant operating whatever business is there. So that's, you know, an important thing to distinguish when determining who you're looking to provide coverage for. Are you providing coverage for the building owner, or are you providing coverage for the tenant? Potentially both. You know, Lessors Risk is a good opportunity for, you know, agents to get their foot in the door to potentially get right to two different insureds, one for the building owner and one for the tenant. So you never know. It's, you know, a good way to try to build a book of business. So then I'm going to, on the next slide, talk about the different types of buildings that we see. I kind of broke it down into 5 types of buildings, how I classify them. You know, everybody can do it a little bit differently, but just to give you an idea. So professional buildings to me generally are, you know, medical offices, including dental offices, professional offices, just more building sites where there's not a lot of foot traffic because you don't have, you know, retail type tenants coming through your buildings like you would in a retail strip mall. You know, generally there you're going to see more mercantile businesses. Not to say that you won't see an office here or a mercantile business here, depending on between a professional building and a retail building, but you can kind of get a sense of like if a building is primarily one or the other. And then other types of buildings, commercial buildings, what I would call a commercial building would be warehouses, buildings that are light manufacturing. So generally maybe there's like a little office in the building, but then they pretty much have a warehouse to either store their goods or for their tenants to make their goods. Also, garage type businesses, things like that. That's kind of more of what I would classify as a commercial building. And then for me, mixed-use building is considered a building that is occupied both by commercial tenants and residential tenants. They can be set up however, but generally speaking, you would see like commercial tenants on the bottom floor, and then say maybe the building's 3 or 4 stories, and you've got apartment units above those commercial units as well. So those are definitely something we can help with. And I will talk about all the rating factors for all of these types of buildings throughout the PowerPoint. And then lastly, I just wanted to go over business park associations. So generally, those can also fall in the lessor's risk category for the individual unit owners for whatever unit they own. But they could be a part of an association that's made up of multiple unit owners, which is different than a lessor's risk where the owner of the building owns all of the units and is renting all of those units out instead of there being multiple unit owners. So I did just want to bring that up. But again, if you have a building owner who is a part of a business park association, whether it's a business park condo or a business park planned unit development, we can definitely assist you with those because we can provide coverage for the individual unit owners who are renting out their units. And then the next couple slides are going to show you just some pictures of, what these buildings may look like. Not necessarily what they truly are, but just to give you an idea. So, picture of a professional building, generally going to be speaking, made up of multiple offices, maybe a company occupies an entire floor or, a section of the floor, however their units are broken up. And then the commercial building, like I said, generally they have like some sort of little office exposure in their building, and then the rest is a warehouse type building. And again, these two buildings are also kind of similar to what I would consider what you would see for your business park associations as well. And then on the next one, we have, a mixed-use building. So as you can see, there's a restaurant space on the bottom, and then above it looks like residential units. So just to give you an idea of that. And then, your typical retail strip mall. Again, could have offices in there. Doesn't have to be just strictly mercantile-type businesses, but again, that's, primarily what's going to be in there are your mercantile-type businesses. All right, so some underwriting characteristics to consider. So you definitely need to know what type of tenant is occupying the building. That is very important because that will determine what markets I can approach, because some markets, don't like church tenants and then others do. So we need to know the type of tenant that there is in order to determine what markets we can take the risk to. Also, another thing to consider is, are any of the units currently vacant? And if so, what percentage vacancy is there? Some markets, require 70% occupied to be considered part of their lessor's risk program. If it falls below that, generally speaking, I'm having to take those type of risks to like E&S type markets because the vacancy is just too great in those buildings, so it doesn't make it eligible with those preferred or standard markets. So we can look at those ones that, maybe are 50% vacant, 70% vacant. If it's 100% vacant, then that would go to my coworker, Teresa. But, taking into account the vacancies is extremely important. And then other things to consider as far as the building goes is we need to know the age of the building. If the building has had updates. And when we're talking about updates, we're looking for updates to the wiring, plumbing, heating, and roof. And generally speaking, most of my markets are looking for full and complete updates within the last 30 to 35 years in order for them to either quote it or for it to be eligible for special form replacement costs, which I will talk about types of coverages down the line, but those are things to take into consideration as well. If they haven't had the updates, I can still consider the risk, but coverage is going to be limited to basic ACV. And then other things to consider, the maintenance of the building. Is there general upkeep of the building? Making sure, somebody tags the building, they're painting the building to ensure that nuisance isn't out there, the overall condition of the building, Does it look like it's falling apart? Does it look like it's in good standing? Those are important things to take into consideration as well. And now, especially in California, and I'd have to say pretty much up and down the West Coast, I would see suit that it's going to follow suit in Oregon and Washington as well, just because of all the wildfires we've been having. The location of the building is extremely important these days because a lot of carriers are now running risk meters and determining whether or not they want to write in that specific location where that building is located. And again, I'm going to talk more about that later in the PowerPoint as well. And then, you want the size of the building. What's the total square footage, number of stories, and is the building sprinklered? These are just some things to take into consideration when quoting it or when preparing your submission. And so I talked about the things that you should be looking for. Some other things you should be looking for are the building is going to get inspected by pretty much every LRO that I write is inspected by the carrier or the third-party inspection company that they use. Just because of the class of business that it is, it's a pretty standard thing for there to be inspections. So I just wanted to go over some things that, I look out for and that what inspection companies are going to be checking for and what the carrier is looking for to confirm everything is in place so that way, once we wrote this policy that it's written properly and we have everything on the policy that needs to be there and the risk is up to par. So again, they're going to, since the rating factor is the building square footage for our lessor's risk, they're going to confirm the square footage. So we want to try to be as accurate as possible with that. So, the insured isn't potentially hit with an endorsement for having to increase the building coverage and the square footage, which, then would in turn affect the rating. And then some other things that inspections are going to check for. Obviously, they're going to confirm the type of tenants occupying the building to confirm, the information we provided them when we first quoted the risk is accurate, so those tenants are still in the building. And then they're also going to check to see if there's any vacancies. Again, like I said, that's a good thing to be checking for originally. They're also going to be checking the construction type, the age of the building, if there's been updates, the type of electrical in the building, the type of plumbing. So pretty much anything that has to do with the building, they're going to check, since that's the primary coverage for the lessor's risk is providing coverage for the building. If they're, it's a multiple story building and they have railings or stairways, they're going to be checking whether the railings are horizontal or vertical. Vertical is preferred. Horizontal poses an issue because they act as a step ladder. So, say a small child decides they were going to climb up and then they get to the top, and then what happens? They look over, they fall over. Not that we want that to happen. So horizontal railings are generally prohibited with markets, but if you put in like a mesh barrier in front of it, then they will consider them. And then also we're looking for the width of the in between the railings. So generally speaking, no more than 4 inches. Some carriers will go up to 6, but generally speaking, 4 inches is the max you want to go with on those widths. And then they're also going to check, like I said, talked about the condition of the building. Is there, say it's a frame building with stucco on it, is there stucco coming off the building? Are there holes? Things like that. They're going to be looking for those things just to make sure that the building is, up to standard, up to par. And then the sidewalks in the parking lot that the building owner is responsible. They're going to be looking for any sort of, potholes, or say there's, I don't know, a sack of trash in the parking lot for some reason. Anything that could potentially pose a hazard and, create a trip and fall type scenario, that's what they're looking for. That's what we're trying to help the building owner with, is to prevent those types of losses from occurring. So keeping your building maintained is extremely important. And then again, they're going to also be looking for the appropriate life safety equipment. So, fire extinguishers, smoke detectors. If your building is a sprinklered building, they're going to be looking to make sure that the appropriate sprinkler testing is being done each year, or however often, based on your contract, that you have to have it updated. Are there security cameras, things like that? That's what they would be looking for in that. And then lastly, a thing that they are definitely going to ask is confirming that the building owner is obtaining certificates of insurance from the tenants, and then making sure that they are also named on their policy. So all the markets that we have for lessor's risk, this is a requirement. So as a building owner, if they don't require their tenants to carry insurance, then I won't be able to assist you. Some of our carriers even require us to obtain copies of those COIs. Not all of them do, but some do, in order to, bind a policy. So those are important things to be on the lookout for, because that's definitely things that are going to be checked in an inspection. And then I want to talk about, how to determine the value for your building. Sometimes, it's a new client to you and you don't necessarily know where to start, and your client doesn't necessarily know where to start because they don't, maybe it's a new purchase for them, or maybe they never had coverage on their building before and decided all of a sudden, that's probably a good idea that I get coverage on my building. So ways to, like, the building replacement cost is going to vary depending on the state you're located in, the construction type, the height and the square footage and the age of the building, and the overall quality. So when I get a submission, I'm always checking to see what the cost per square footage comes out to. So in doing so, in that, I'm taking whatever building limit you give me, dividing it by the square footage, and that gives me the cost per square footage. So then I'm like, okay, so generally speaking, I see the cost per square footage from anywhere from 100 to like 250. Again, it's going to depend on the type of building that it is, and where the risk is located. Some areas it costs more to replace your building if there was a total loss. Other areas a little bit less. So those are the things that I'm looking at. Sometimes I'll get one and it will come in at like $33 a square foot. That's pretty low. So I'd want to know, why are we looking at that? Like, why is it so low? So in that instance, I would probably be asking you for some sort of building valuation report that will, confirm the limit you're looking for, because we, our policies are going to have, most of them are going to have an 80% co-insurance clause. So meaning that the building needs to be insured to at least 80% of value. Otherwise, if there is a loss and they're not, then the insured is going to be penalized for there being a loss, for not having the building value insured properly. And then, so I've talked about how to determine it. So say you have a building owner who owns multiple buildings, owns, let's say, 5 or 6 buildings across, their city that they're in, which is totally fine. We can definitely assist you with multi-location lessor's risk, not a problem. So what I would need for those is some sort of statement of values, or an SOV as I call it when I abbreviate it. So what I'm looking for on a statement of values is it's breaking down the buildings for me by, the number of units, if it's a mixed-use building and it has residential units in it, the overall square footage, and the property limits. So it provides me a breakdown, and I will show you guys an example of one in the next slide, but just some other things to consider when putting these statement of values together. So like I said, we can use them for either multi-building complexes. So, say one insured owns 3 buildings on the same plot of land, not a problem. We would just need a breakdown of each building, or if they have multi-locations. Again, just providing us a breakdown is really helpful, because I have to provide that to the carrier as well, because most of our carriers do not offer blanket limits. So, and the ones that do still do require a statement of values, just so we, are making sure we're insuring each building properly and to value. And then again, on these statement of values, we can also include additional property components that the building owner may have. Maybe at this location there's a detached garage. We want to make sure we're providing coverage for that. If there's fences, signs, if the building owner happens to, provide, say, table and chairs outside of, say, a restaurant type tenant, and they're the ones that own those table and chairs, then that would be BPP of the building owner, and we'd want to offer them property coverage to that. So in the event of a loss, it's covered. The only thing we wouldn't want to be providing is any sort of BPP coverage for the tenants. And then again, determining what's attached versus what's detached from property components. So say there's a sign on the building. Is it attached to the building, or is it freestanding? Things like that you want to consider, in order to make sure we're providing all the coverages that your insured needs. And then on the next slide, this is just, a basic statement of values that I use and I send out to people who don't have one. Really, I just use an Excel spreadsheet and then just break it down for you by building, by location, if there's detached things. Just as you can see, I just listed like the other types of property coverages you may find. Obviously, most of those aren't going to apply to probably a lessor's risk type building, but just to give you an idea of other components to take into consideration. And so just like I said, again, at minimum on a statement of values, I'm looking for the square footage, the number of units, and the property limits that they're looking for. Business, including for the property, including, the building insurance and the business income, and then potentially the BPP. All right, so let's talk about the types of coverages that a lessor's risk policy can have and would potentially need. As I said, property insurance is the most, generally speaking, for a lessor's risk, the most important part of the coverage because that's providing the insurance to the building, and then any other property components. And again, the property components, we are only looking at that of the building owners. So if the building owner doesn't have any other property components, then the only thing we'd be concerned about providing them property coverage for would be the building. And then business income, super important for them. So that's their loss of rents coverage. So with that, I do need a figure. I do need to know what their loss of rents are. Some of our carriers will offer ALS, actual loss sustained, but regardless, I still need to know what their annual rents are. And then other coverages that you can put on with the building ordinance coverages. So you can have coverages A, B, C. So we can offer pretty much any combination of those coverages that they're looking for. Again, this is, we're enhancing the property coverage at this point. We're adding on to give them, the broadest policy that we can. Equipment breakdown, we can include that. Most of our carriers have some sort of property enhancement endorsement, and so as long as they qualify for that, we'll be adding that on for them on the property side of things. And also the lessor's risk. Some people think, oh, I just need building coverage. I don't, that's my only exposure. No, they should also have general liability as well because they own that building and the land that it's on. So potentially, if there's a trip and fall in the parking lot, the building owner could get pulled into the lawsuit just as much as the tenant of the building could get pulled into the lawsuit. So having the general liability is extremely important for the building owner as well. And then on top of the general liability, we can add on the hired and unknown auto as well. So that's not a problem for us to add on to round out the whole package for them. And then just some cover features to go over. So most of my markets offer standard 1-2 GL limits. Some carriers I do have will offer 2-4, and if they can't and they need higher limits, we can definitely offer you an excess quote or an umbrella quote, depending on what other coverages we're going over, up to $5 million. Most of my carriers do not have a general liability deductible for lessor's risk, so that's always nice. And then property limits, I've put $50 million up here. It really depends on the occupancy, the building type, and where the risk is located. So it could be higher, it could be less. It just depends. So if you have one you want to discuss with me, just let me know. We can go over that, and I can definitely let you know if we would have an option for that. And then as we talked about earlier, special form replacement cost is our goal to offer that coverage for your clients. However, that is going to depend on the age of the building and if there's been updates to the building, if it's an older building. We do have markets that will take the older buildings. I think I've written things as early as the late 1890s. So we can definitely consider those buildings. That's not a problem. But we will be looking for those updates, and we are looking for full updates within the last 30 to 35 years to the wiring, plumbing, heating, and roof. And again, without those, we would just, if I have a market for it, would be offering you basic ACV. And then, a lot of these are mortgage type buildings, so we can include the mortgagees and loss pays. They're automatically included on the policies at no additional cost. And then, so this is a lessor's risk profile that we worked up. So we've prepared this. It's on our website, available for all of our agents to, use as a tool for them to gather information. Say, a client comes into the office or gives you a call. I'm going to buy this new building. This just gives you a way to, jot down some basic information about it, before you start doing your research on the building to see what other information you can find. This I cannot quote off of. It is really just a cheat sheet or a tool for you to use in order to gather information and then fill out the applicable accords forms that I would need and any supplemental application. It's also a tool that you could send over to your insured as well to, fill out what they can on there as well. So just a way to gather the information so it's not like just scribbled on a sticky note here and there. That's what we're looking. Just an idea of some things to be on the lookout for. And then what do I need to get a submission? So I need from you, I need an accord 125, 126, and 140. And make sure at least somewhere on there the building square footage is included, the type of tenants, or the annual rents. Again, If you put the tenants in your email to me or you send me a rent roll, that's totally fine. I'll jump down to the rent roll bullet point. So a rent roll or a tenant listing, that gives me a list of the tenants that are in the building. Generally, it provides the square footage that specific tenant is occupying. So generally, I get these on like multi-unit buildings, things like that. And then also generally will list if there's any type of vacancies in there. So if you have a rent roll, that's always important, and you provide that to me, it's great. Otherwise, if you just list out the tenants either on the Accords or in somewhere in your submission, that's totally fine, as long as I just get a list of those tenants. And then we do need a lessor's risk supplemental. For most lessor risks that I'm quoting, I will need some sort of supplemental. I can work off of most carriers' applications. If you guys don't already have one completed, there is an LRO supplemental available on our website. It's a 3-pager. It's pretty simple. You know, sometimes they don't have the answers to all the questions, or some of them don't apply, so you can just skip over those. And then we did talk about the statement of values, so I would need that again if there's either a multi-building location or a multi-location type risk. And then 3 to 5 years loss runs are extremely helpful. We can definitely quote subject to clean loss history, but if you have the loss runs up front, those do help me. If they have had losses within the last 3 to 5 years, I won't be able to move forward unless I have those loss runs. And in addition to needing the loss runs, I would need a breakdown of, you know, what the claims were, so what happened, confirmation that damages have been repaired, and then if they could take action to try to prevent future losses, like a similar type instances from occurring again, I will need that. Because I have to, you know, I have to be able to try to sell this to my underwriters as you guys are trying to sell it to me. So the best way I can write it up to them and send it to them is what I'm looking to do. And then, of course, if you have a target premium, that's extremely helpful as well. Just so you know, I can kind of tell you sometimes I can look at a risk and be like, there's no way I'm going to be able to compete with that. So we're not, you know, wasting all of our time and dragging along and be like, okay, sorry, never mind. So if you have one that's helpful, I know you don't always, but you know, if we do have one, it's definitely helpful for us to go off of. And then the last thing I wanted to talk about are just some industry changes and trends I've been seeing. So I definitely have been seeing a change with carriers on the type of tenants that they're allowing. You know, some of their occupancies have tightened up, and you know, tenants that they used to take, you know, just last week or down the line, they're no longer accepting those type of tenants. So I've definitely seen changes in that, depending on where the risk is located. I know I talked about earlier, specifically in California, we as underwriters at CID, for anything that's looking for property coverage, we have to brush and wildfire map the risk. So we're running a risk meter on that. And depending on where their score comes in, is depending on if we'll have a market or not. Some of our markets will take things that are in a high brush or high wildfire area. However, you know, the rate is pretty expensive on the property side things, minimum of $2. So I know it's becoming a little bit more challenging, specifically in California. I would have to say I have a feeling that this will probably be taking effect in other states as well that have had, you know, severe wildfires like California has over the past few years. I definitely will probably have a feeling that that's going to continue to be an industry change. And then some other things that I've been noticing is carriers are tightening up on the age of the building that they will accept. You know, things before, we're in 2021. Things built in 1970 or earlier, you know, are starting to seem a little bit older than what they are. You know, it's just how it goes. We're all moving along on that age bracket, unfortunately. So the buildings, they're subject to this as well. So, you know, things that, you know, a carrier was writing that was built in the 70s, you know, 10 years ago, they might not want it anymore because they've tightened up on what building age that they're looking for. And sometimes this is even true regardless of if the building has had updates. You know, some of these buildings I know have been gutted entirely and it's basically brand new, but since the original build date was, you know, say 1950, this carrier no longer wants to take it. And then one other thing specific to California that I've been seeing is if you have a mixed-use building, a lot of carriers for apartments in general have been making changes to the way they write apartments. So apartments would be included in the mixed-use building since they do have the residential units. So carriers have either jump shipped for apartments as a whole, or you may have seen that a lot of carriers are now adding some sort of habitability exclusion onto the GL because of the residential units and the types of claims they've been seeing. So those are just some changes and trends I've been seeing. You know, things are always changing. As agents, you guys are always keeping me what you hear and what you see. I always appreciate, you know, this information, and I try to pass along what I hear. And, you know, if I know something, I try to let you guys know. And if you know something, I mean, I get people telling me, you know, this carrier is no longer doing this. And so, you know, that opportunity and that relationship for us is really important to be able to share this information with one another. And then that's all I have. So if anybody has any questions, feel free to post them in the chat. And if we miss you before, don't worry. I will get a copy of any questions that you have, and I can definitely send you an email and let you know and answer any questions you have. My contact information is on the screen. My phone number is there, and then you can submit your applications. You can submit those to our submissions email, or you can send them directly to me. If there's something you want to talk about before you put a whole application together, feel free to just give me a call or shoot me an email, and we can definitely discuss it before you go through the hassle of getting all of the applications together.
Thanks so much, Michelle. Great job. Good information. Thank you all for joining us today. And visit our website at cidinsurance.com to find out all of our tools and see our applications. So have a great day.